heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
SoFi shares are surging after posting its first ever profit. Our conversation with the CEO, Anthony Noto, that's coming up.
Plus, shares of iRobot slump as the Amazon deal is scrapped and the CEO steps down. Details on why the acquisition was terminated.
And a real sign that tech companies are throwing their hats into the 2024 IPO market revival ring. We talk about Reddit's public market plans and its potential valuation. But first, well, let's check in on the companies that are already public and where they're trading. Because right now, we are waiting on so much economic data, a Federal Reserve rate decision, of course, whether we'll be selling more debt here in the United States. There is a lot to digest, not to mention the $10 trillion valuation of companies that are coming out with their earnings this week. So we pause, we wait. We see the Nasdaq basically up only about 10 points. We're seeing the 10-year yield actually just falling down about 3 basis points. Interesting, as we do anticipate the overall Treasury to be signaling that they will be issuing yet more debt. We are down by some 3 basis points, so a little bit of purchasing. Now remember, this is amid yet more geopolitical tension. Maybe there's a flight to some sort of safety. As we see actually oil on the downside by a percentage point, we have been tracking higher after those concerns of increased tensions in the Middle East, not to mention, of course, US personnel being killed over in Jordan. We focus in on what's happening in geopolitics, but we move on what's happening in one key risk asset of choice here at the Technology Show. We see a little bit of a spike higher in the world of Bitcoin. We're up about 1.6%, 42,668. We are clawing our way back, Ed, after what has been a bit of a sell-off post, of course, the Bitcoin spot ETF coming into fruition. What have you got on the micro, though?
The big tech story of the day is Amazon walking away and scrapping its acquisition of iRobot. Treading water on Amazon shares because I think we knew this was coming, right, based on all the reporting of late. But iRobot is down significantly because adding to the fact that Amazon has walked away, and this is a case of Amazon jumping before it was pushed by EU regulators, iRobot CEO Colin Angle is stepping down and they're cutting jobs. This is a pretty big situation. We're going to go to Brussels later in the hour, speak to our reporter there, and then we'll go to Seattle and get the Amazon side of this story halfway through the show as well. Keep watch on this. And as I said, Amazon shares, look at the kind of muted reaction. We think that this was coming. The other big mover to the upside is in the earnings context, and that is SoFi, actually on track for its biggest jump since late July, first week of August. Why? Profitability for the first time on a net income basis. This is the milestone that the street was looking for. There's a lot going on the technology side of SoFi's business and a lot going on the lending side and finance side of its business as well. Who do we speak to? The CEO, Anthony Noto, joins us now. And Anthony, we've been through this process psychologically, that first profit with a number of companies before. What were the main contributing factors to you guys hitting profitability on a net income basis? And how confident can the street be that you continue on this arc of increasing profitability?
Ed, thank you for having me on. The main contributors to the profitability is that we finally reached the scale in our non-lending businesses that they are now profitable. And so we have 3 profitable segments. When I joined the company 6 years ago, we were primarily a lender. That's a very profitable business for us. We've entered the technology platform services business where we enable 140 million accounts throughout the United States and LATAM to do payment processing as well as core banking technologies and a number of other financial services technologies that we use at SoFi, but we also sell to others. And then our third segment is our financial services segment, which consists of products like SoFi Money, which is a checking and savings account, SoFi Invest, SoFi Credit Card, SoFi Protect, which is insurance. Those businesses required a significant amount of investment over the last 6 years, but we've now reached the point where they're 40% of our revenue in the fourth quarter compared to lending at 60%. And they're profitable. And so that inflection point hit this quarter. And as we go into 2024, we believe the businesses will be 50% lending, 50% tech platform and financial services. And with all 3 being profitable, the profitability is sustainable.
I'm trying to understand that guidance. So you're basically saying 50% compound annual growth on the financial services business over kind of this pretty wide window, 2023 through 2026. What gives you the confidence that you can see that far into the future in terms of how your company will grow that segment?
Sure. Just to clarify for viewers, I was suggesting that we'll have 50% of our revenue from lending in 2024 and 50% of our revenue from the two other divisions combined, the technology platform segment and the financial services segment. In terms of our longer term revenue growth outlook, we are forecasting 75% growth in the financial services segment in 2024 and 20% growth in the tech platform. From the 2023 through 2026 time period, technology platform will come down to 50%, and technology platform will be mid-20s, and the financial services segment will come down to 50%. And the reason we could see that is because we understand our customer acquisition cost, how much we spend on marketing, and that drives the adoption of the products, and then they monetize at a rate that we've seen over the last couple of years. And so they're pretty strong leading indicators of what the future brings from a growth perspective.
One thing, of course, on your call that you made clear to analysts is, look, let's face it, no economist has got this economy right in the last couple of years. How do you feel about the macroeconomy, Anthony?
Yeah, we're very conservative about the macro outlook. Specifically, I don't believe it will be the case that we could have 6 rate cuts, which is what the forward curve shows, and a strong economy. I think if we actually get the 6 rate cuts, it's because we're likely with unemployment above 5% and likely with contracting GDP. I think it's more likely that we'll have fewer cuts and maybe a stable economy. But coming into October, many market pundits were talking about higher for longer. 90 days later, they're talking about 6 rate cuts. It's such a bifurcation of views, it's really hard to know what the real outlook is. And so we're taking a very conservative view, and we can do that given the diversification that we have on the lending business and with the other businesses. So we're going into next year with tighter credit and also lower expectations. In fact, we're really just forecasting maintaining our revenue in lending, not growing it, and the other businesses driving the growth that I mentioned.
And with that sort of growth, you still have that goal of a 30% return on equity. You still have that goal of being in the top 10 in terms of financial institutions here in the United States. What gets you there in terms of your underlying investments that you now need to make, Anthony?
Sure. In 2023, we were able to grow our revenue 35%. We just hit our long-term EBITDA margin of 30%, which is what's required to get to the return on equity of 30%. Now we just have to scale the EBITDA dollars against our book value. We grew tangible book value by more than $340 million this year, and we're looking to grow it even faster next year at $300 million to $500 million. And so the profitability of the business is there. Now it's about just scaling the revenue, which will scale the returns on equity to that 30% level that you mentioned. We've been in these businesses now for 4 to 6 years, and we have pretty good leading indicators of what it takes to drive their growth, and that's what's giving us the confidence in our forward outlook.
Anthony, our colleague Paige Smith on the fintech team is talking about your technology business. Our colleagues at Bloomberg Intelligence are talking about your technology business. This is the Bloomberg Technology Show. What are we talking about when we say that SoFi is a tech company? What is the strength that you have there?
Sure. Obviously, we have to build our own technology. We're a financial services company with no physical locations. And so the only way our products are delivered is through the mobile app or desktop services. So by definition, we have to have technology to do that. In addition, we have to have processing capabilities and operating systems. We use for processing a company that we bought, Galileo, back in 2020. Galileo is powering about 140 million accounts in the United States to do payment processing on debit and ACH rails, but also it's developed a whole suite of APIs that allows a developer to tap into those APIs and build account opening or a direct deposit or 2-day early paycheck or payment risk platform. In addition to that, we have a technology platform that's a core banking technology called Technisys. It's really the operating system for products. It's a multi-product platform. We use it for SoFi Buy Now, Pay Later. Those are the 2 main products that we sell to third parties. And as I mentioned, servicing about 140 million accounts in the United States and LATAM today.
Anthony, I think we've got to talk about the share reaction, right? Your gains are holding at around 23%. You know, I talked about that psychological milestone of net income profit. But do you finally feel like you're getting some credit? Because you've been talking about this plan for a little while. I have a sense of deja vu. We're talking about the same things now as the 2 previous times you've been on the show.
Sure. I think that the inflection point in this quarter is one, hitting our long-term margins of EBITDA at 30%. So that gives people a longer-term view on what our profitability could be. Second is 40% of our revenue came from the technology platform business as well as the financial services business, which means 60% came from lending. And so as we go into 2024, we're calling for that split to be 50-50, as I mentioned. That's also an inflection point. People have been waiting for that for a while. And so while there's a lot of talk and debate about the loans and fair market value accounting versus cost accounting, the reality is that our business is much more than that. And we're starting to get the perspective from investors about that broader diversification. And it's not by accident. We embarked on a strategy to be a one-stop shop 6 years ago for all your financial services needs. Our mission is to help people achieve financial independence, which means we have to help them get their money right. And we can't just do that in one product. We have to do it across borrowing, saving, spending, investing, and protecting. And what you're seeing in our results is that strategy playing out in diversified revenue and high profitability 6 years later.
Interestingly, not in crypto anymore. But interestingly, what I'm taken with on a day like today, where we see the Amazon iRobot merger have to be put on ice. With your background as someone who helped lead the overall investment banking offering over at Goldman Sachs when it came to TMT, when you're thinking of your own acquisition strategy, can deals get done at the moment in the world of tech, Anthony?
I think they can get done. We're not focused on doing deals at SoFi. We're focused on our strategy and executing organic growth. We feel like we've reached the point now where it's ours for the taking, and the opportunity for us to be the winner that takes most is completely up to our execution. But more broadly, I do believe there's still M&A that will happen across both technology and financial services. I think financial services is probably a little bit more challenged because of the regulatory backdrop than technology is per se. But deals are getting done. They're just harder to get done, and they're going to courts. But in court, people are winning. I think what you've seen in some of the breakups is really about business performance, not about regulation, and businesses underperforming relative to expectations, and therefore buyers being able to get out of those deals.
Nothing like some buyer's remorse. But for now, we really appreciate the time that you spent talking us through your own numbers and your focus. Anthony Noto, SoFi CEO, we thank you. Meanwhile, coming up, we're going to dive into that regulatory issue and maybe an underperforming business. Amazon abandoning that $1.4 billion acquisition of Roomba maker iRobot. We've got all the details on the clash between EU regulators and the tech giant. That's next, Ed. But what are you watching?
Yeah, shares of Apple and shares of Rivian. It was a busy weekend for Bloomberg's Mark Gurman and I. We reported that a really long-time and important Apple exec, DJ Novotny, has left Apple, and my understanding is today is his first day at Rivian as Senior Vice President of Vehicle Programs across products and engineering. This is someone who led the home devices business at Apple and was involved in the Apple Car project. Rivian higher 3.5%, Apple softer 0.9%, waiting for the companies to confirm that one. This is Bloomberg Technology. Amazon has scrapped its planned $1.4 billion acquisition of iRobot after clashing with European Union regulators who had threatened to block the deal. iRobot announced that CEO Colin Angle would also be stepping down as the company implements a restructuring plan that will result in 350 jobs being cut. Here with the latest is Bloomberg's Sam Stolten out in Brussels. And Sam, earlier in the show, we kind of framed this as Amazon jumping before they were pushed, because we know that the commission was looking at this very closely and probably would have blocked the deal. What did Amazon outline in their regulatory filing?
Hi, Ed. Well, good to join you here from Brussels this afternoon. Yes, indeed, we were just days away from a potential European Union veto over this $1.4 billion acquisition from Amazon. The news was really that last week Amazon had held a meeting with EU Commission officials, and the EU had signalled that it was its intention to block the deal. There was a deadline of February the 14th for the EU to come to a decision, but Amazon seems to have jumped the gun now and decided that it's not worth risking that negative publicity from the European Commission, and it's withdrawn from the acquisition.
And of course, we've heard from Margaret Vestager before about concerns surrounding big M&A deals, about where they take issue. Just take a listen to what she told the show a few weeks ago.
In any merger, it is so that if we have concerns, it is for the businesses either to address these concerns by debunking them or by addressing them by coming up with remedies that will solve the problem. And if a company say we will not come up with remedies, well, then, of course, we expect that they have good arguments that our concerns should not be sustained. And we are still in the process of assessing our concerns compared to a situation where we do not have a remedy to the concerns that we have drawn up.
Sam, it was interesting. We were just talking to Anthony Noto. He used to be the head of TMT, investment banking co-head over at Goldman. He's now, of course, CEO of SoFi. But he was saying, look, deals that aren't getting done are largely because there's buyer's remorse. It's not so much that deals can't get done. From your perspective in Brussels, do you think that's true?
Yeah, I think to a certain extent, absolutely. I mean, in cases such as Amazon iRobot, the European Commission really needed something almost symbolic to say that it could rubber stamp this deal and give it the green light. And as we heard from Margrethe Vestager just there, it clearly wanted some sort of a remedy to be filed in this case. The deadline for that remedy passed a couple of weeks ago, and Amazon, in fact, offered nothing to appease those original concerns from the European Commission when it said back in November that this deal could result in a distortion of competitions on the market for robot vacuum cleaners and also result in higher prices for consumers. So Amazon decided not to come forward with an olive branch or any form of concession in this case. And really from that point on, the deal was doomed. Now going forward, it creates a lot of uncertainty in the boardrooms regarding these large technology mergers. This isn't the first time that companies have withdrawn from a potential deal after getting intense regulatory scrutiny. You may recall recently that Adobe walked away from their $20 billion merger with Figma after getting similar scrutiny over that deal. And indeed, they had to pay a $1 billion walkaway fee in that case. For this time, Amazon's fee is a bit cheaper. It's just $94 million. But I'm sure it's not lunch money, at least.
And certainly not for a company like iRobot that now is having to lay off 350 people, 30% of the workforce, and the CEO. Here he goes. Sam, absolutely brilliant to get the update from you. Sam Stolten over there in Brussels. We thank you. Meanwhile, coming up, well, we're going to dig into companies that, well, maybe are still in growth mode and wanting to prove it to the public markets. Equity Zen head of market insights, Brianna Lynch, is going to be joining us to discuss, well, what 2024 holds and whether Reddit is going to make a debut and at what valuation. This is Bloomberg Technology. Could 2024 finally be a bit more of a year for tech IPOs? Well, look, Reddit is weighing some feedback already from early meetings with potential investors. Company being advised to target at least a $5 billion valuation if it goes public. That's according to sources. Let's bring in someone who's at the cutting edge of what valuations look like on the secondary market. Equity Zen head of market insights, Brianna Lynch. It's great to have you with us, Brianna. And well, look, this was a company that raised money at, I think, a $10 billion valuation. Could it eke out $5 billion by some of the maths that you're seeing?
It'll be interesting to see. I think the key here that we don't have the answer to yet is whether or not Reddit is profitable. So when they first made plans to go public in early 2022, talking about even a $15 billion valuation, they were not yet profitable. Scrap those plans, coming to the market again. And I think that's going to be the crux for where this valuation plays out. When we look at the cohort of tech IPOs in late 2023, so the Klaviyo, Instacart, Arm Group, these were all profitable companies, and they still had lackluster performance. So at a minimum, I would assume that Reddit is near profitability, but there's a lot to be learned from their S1.
Profitability key, also perhaps talking up artificial intelligence. Is that what's going to dictate whether companies could come in any sort of window that opens in 2024?
Yeah, I think any company that can play into the AI buzz will obviously use that, whether that's a marketing tactic or a key part of their business is, a separate question. I would say when we're looking at Reddit we're really talking about their advertising business. You know, as a core social media platform, they generated over $800 million in revenue from advertising last year. That's up 20% from the prior year. But there's a lot of competition with TikTok and Meta and others in the space. But I would also say that there is investor interest for these social media platforms. We haven't seen one of them go public since Pinterest back in 2019. And, you know, those stocks have really rallied. Pinterest debuted at $10 billion and is now trading at a $25 billion valuation. So perhaps they're hoping to, you know, jump on some of that momentum.
Brienne, how much emphasis do you put on the idea that if Reddit does this, pulls the trigger, it opens up a broader IPO window for everyone else that's waiting in the wings?
I think a lot of private companies have been waiting for the hero company to come out and have this vastly successful IPO and welcome others to follow. Obviously, we haven't seen that yet. So the companies that are choosing to go public now are, you know, taking on a bit of a leadership role and hoping to play that part. But what we're hearing from the heads of NYSE and NASDAQ are that there are lots and lots of companies who are starting their roadshows, putting their pieces in place because they feel the pressure to IPO and they're ready to IPO. You know, when you look at Reddit, for instance, this is a 19-year-old company. There is both a liquidity need for early employees and shareholders and just an investor access need from retail investors as well. So if a Reddit goes well, I think there'll be other companies that look to follow.
Let's spare a thought for Reddit, right? Yes, you talked about their ad business. They have a premium subscription tier, but lots of companies go public because they want their name out there. You know, I don't think we've really been talking about Reddit for a little while. Do you think that that's a good strategy to go to market with?
Yeah, and I think it's a strategy that could really benefit them, especially given who their platform is. Their subreddit, Wall Street Bets, really started the whole meme stock frenzy. So there is a core part of their users and their platform that is around investing and in particular retail investing. So I think one interesting thing about this IPO to watch will be if those Redditors get on board, will you know, Reddit become the next meme stock? That would be kind of meta, but at a minimum, is there investor interest from these platform users? So I think, you know, from a marketing and brand perspective, this IPO chatter is helping to get their name out there, and whether or not that will translate to investor interest, we'll see.
Brienne Lynch, head of market insights at EquityZen, thank you so much. As we point out, $5 billion would be half the $10 billion they raised that last year. Now, coming up, we're going to get even more on that deal between Amazon and iRobot that is scrapped, it is cancelled. Plus, ads are coming to Amazon Prime Video. We're going to have all the details next from our man in Seattle. You know who it is. It's Bloomberg's Spencer Soper. From San Francisco and New York City, this is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Carrie, you mentioned earlier in the show, we're kind of treading water on the NASDAQ 100, right? Because it is a mega week for mega cap tech earnings. That is what your calendar looks like for this week. Join us on Bloomberg Technology every single day because we will look ahead and we will review $10 trillion of market cap reporting this week. And those are the names that move the needle, right, across everything from the ad space, consumer tech, enterprise. It is going to be really massive, and the AI story, I'm sure, will be weaved within that. Amazon's interesting Thursday, but they're in the news cycle right now. Looking at the shares, we are completely flat on Amazon stock as they scrap that $1.4 billion deal with iRobot, or to acquire iRobot. We kind of knew this was coming, right? Bloomberg's done a lot of reporting on the European Commission probably likely to block this deal anyway. Amazon moved first. But from iRobot's perspective, the CEO, Colin Angle, is departing and 350 jobs or so will be cut. I guess the question is, well, does Amazon lose anything by not acquiring iRobot? That's a tough one to answer.
Well, we've got the right person to ask, right, on this scrap deal. Let's go to Spencer Soper, who covers Amazon for us. And Spencer, the idea is that maybe this deal didn't get done because there's a bit of a buyer's remorse here. Do you feel that that's the case?
Yeah, I think that's definitely a sharp point. Like if Amazon felt it was worth fighting for, it would fight for it. They fight for things. So the fact that they're walking away, and of course they're going to take their swipes at the regulatory agencies, and while they're doing it, but really just looks like maybe the enthusiasm around this deal has softened. If you think several years ago when they were really going heavy on their connected devices and Alexa, and there was all this buzz around the connected home and that sort of thing. A lot of this just kind of faded. These things seem more faddish. I don't know. I've got one of these robotic vacuums in my house. It just sits in the corner. We never use it. It makes a racket. I just say, give me the vacuum. I'll do it myself. It'll take.
I've got two, and ours are always being deployed.
Yeah, it takes too long. So I don't know. I do think that there's something to that. Amazon was kind of happy to have a reason to walk away from this one.
Okay, so Spencer, you and I always try and think holistically about Amazon. When they do something, it's often to bring it into the wider ecosystem on Prime or Alexa. That's harder to see with iRobot. But your latest piece on Bloomberg is about ads and turning televisions into shopping carts. Explain your thesis.
Yeah, well, so Amazon turned on ads on Prime Video. They're expecting it to reach 115 million people in the U.S. each month, and they're kind of a latecomer to the ad-supported connected TV, but they'll be a big player and they'll sell a lot of ads. But if they're really going to win here, it's going to be to get people to engage with their TV, and that's where Amazon is in a stronger position than anyone else because it's got the online store behind it. It can, feature all kinds of inventory, and potentially, if you get people to watch TV in a different way, potentially people will actually shop from their television. Maybe, scan a QR code on the TV and get taken directly to a product page on their Amazon app, or even through inaudible tones. Your television will be sending messages that you can't really hear, but your mic can pick up on it and take you to that page in your shopping app. So I think if they're really going to differentiate, they got to get people engaging with the television.
The story on Bloomberg is titled "Amazon's Video Ad Push Aims to Turn TVs into Shopping Carts." It has those charts that we just showed you. Check it out, Bloomberg Spencer Soper with the reporting. Let's keep the conversation going with Melissa Burdick, president of the ad campaign managing platform PackView. And you just heard Spencer's reporting, Melissa. We showed you the data in the charts. What do you see Amazon doing in this kind of conversion of eyeballs through the screen to ads to shopping baskets?
Yeah, just to add to what Spencer said, Amazon has a huge advantage with all their rich retail media data. So not just being able to have shoppable ads, but the ability to retarget people. They know what you bought. They can show you the best ad. If you're in market for baby bottles and formula, you're a new mom, they can share and show you the most relevant ads, and that has better performance. And right now, advertisers are really cracking down on performance. They want to make sure that their advertising dollars are as effective as they can be. So Amazon has such a great advantage with the ability to have rich retail media data, real-time sales information, and show you the most relevant ads.
You've got, what, $13 billion in ad spending to oversee at your digital marketing company, PackView. How many of your clients, how much of this sort of money is going to be put to work on Amazon, do you think?
This is a very new product, so just keep that in mind. We have a lot of clients that are starting to use this new product. And right now, it's kind of the big brands that are starting to use this. But Amazon's ambition is to bring this to the SMB, to the smaller brands, mid-market brands, kind of democratize the ability to get this through self-service. So you don't just have to go through a third party or an agency. They're bringing this to the masses. And so that's kind of also compelling in that not just big brands will be using this, but ultimately everyone can get into this space.
Shoppable TV is something that Asia's taken to with force, and we're just still a bit uncomfortable about the whole situation. Is this something that will just organically spread and give it 5 years and I'll forget that I ever thought that this was a weird thing to do?
Right now it is weird. I mean, you see a QR code or, whip out your phone and, take a picture of it and go shop when you're watching movies. So that experience, one, we're gonna have to get used to it. Two, Amazon will continue to innovate in this space. And then three, during tentpole events like Prime Day and Black Friday football. I don't know if you watched Black Friday football this year, but there are QR codes all over the place. And when you're sitting on the couch, you're thinking about shopping, a QR code, that's more relevant to you. So you're gonna go ahead and do that. But when we're sitting there watching a movie and in the middle of it, you see a QR code, are you really gonna, have that desire? And that is going to drive innovation and change. One is changing the mindset of consumers, so we'll get more used to it. And then two is just the formats will change. It'll continue to innovate. So, Amazon has this day one mentality. They're going to continue to think about how can we bring this to the consumer that they're going to want to use it.
Minister Burdick, love having you on the show. Thank you, President of PacView. Always interesting stuff. Meanwhile, coming up, we're going to be talking about how, there's a sort of a depleting number of public companies out there at the moment. How is that impacting VC strategists and strategy more generally? Hippo is going to be joining us, managing partner Eric Hippo. Stick with that for us. This is Bloomberg Technology.
The world's largest private equity firm, Blackstone, is setting its eyes on AI data centers, and it's on a quest to become the country's most sought-after landlord to big tech and the world's biggest by power capacity. I want to bring in Bloomberg's Kara Wetzel, one of our editors here in San Francisco. So this is interesting. We're talking about Blackstone becoming an AI player, and we know all about the compute capacity needed and cloud capacity for training and inference on the LLM side. But what we're really talking about, I think, is Blackstone investing in and controlling the real estate, essentially.
Exactly. So Blackstone is a huge real estate player. It's the biggest part of its whole firm, the biggest business. And it's actually known for, kind of going into these industries and identifying where there's a shortage of space relative to demand. And so it's done this with warehouses. When it saw the e-commerce boom, it's created a big warehouse empire. It did the same with single-family homes for housing. And now, a few years ago, it started to see all the demand needed for data centers and the coming, electricity needs that are coming. So it bought QTS Realty Trust in 2020 and kind of got really lucky by sort of the rise of generative AI that really just made demand explode. So now it's going all in on this bet, giving QTS a lot of money to rapidly expand and become, the biggest data center provider in the U.S.
Yeah, $10 billion takeover all the way back in 2021, coming home to roost, Kara. I'm interested in where this real estate footprint ends up being. Oh, we're losing some technology behind you. But tell us a little bit about which states, where looks appetizing to build out.
Well, one of the biggest areas is in Phoenix, and they have a really giant data center there. They're building 5 buildings at a giant complex that's going to be sort of the crown jewel. We have reported that Microsoft is going to be one of the tenants there. There's another part of Phoenix that's 400 acres. They're trying to develop Northern Virginia, which has, of course, long been a data center hub because it's where intercontinental fibers connect. So it's a high-speed area. So they're growing there. There is a big project underway called the Digital Gateway with Blackstone and Brookfield trying to build a new data center corridor in Manassas, Virginia. That has been the subject of some pushback from residents and backlash, and sort of in process now. But those are some of the main growth areas, but really kind of different spots across the country.
Well, maybe everyone wins a little bit from this AI focus. Kara Wetzel, we thank you so much for that really well-read story currently on the Bloomberg Terminal and on .com. Meanwhile, let's talk about AI opportunities more broadly and what it's doing for the VC segment. We've got VC Spotlight, and we're going to look at that all with Eric Hippo managing partner, Eric Hippo. It is great to have some time with you today, Eric. And before we go into the landscape of public versus private, I want to ask you about, where you're putting your money to work at the moment. You're doing deals, much of that in AI here in New York?
We're not doing pure Gen AI deals at the moment because they're too expensive and there's too much of a frenzy. And it's hard to tell exactly, to pick your winners at the moment, what's going to end up on the main LLM platforms, the big tech companies, and what's going to be a standalone company. Having said that, the great majority of the companies that we invest in these days are really data-driven companies, and so they employ AI in many different fashions. So we're doing a lot of that. We're doing a lot of automation. We're starting to do quite a bit of climate and clean technology, asset light, mostly in the electrification phase. And we continue to do a lot of healthcare, both on the consumer and on the enterprise level, at the enterprise level.
Yeah, you've been making some new deals that I've seen on your website. Also got a lot of things in stealth. I'm interested in your own expertise, and what we all know Eric Hippo for is well, how much experience you have in the world of media, and with the fact that you're in new offerings like Now This News, but the fact that you really built up your experience having been at the likes of, well, I think of the Huffington Post. How much is AI going to play in to the future of media? How much is it decimating it?
We haven't really done a new media investment now in a number of years, maybe 2 or 3 or 4 years. And one of the reasons is that media is in shambles at the moment. As you can tell from all the layoffs that have been happening, you can tell from the switch in the big platforms and in video from broadcast and cable to streaming. And so all of this kind of needs to settle down. And to your question, AI is going to have a big role, good or bad. In the media space, and that's still to be determined. What is an AI-driven story? What is true? What is not true? What needs to be copyrighted? What shouldn't be copyrighted? All of these questions loom really large in the media industry, and it's going to take a few years to sort this out.
Eric, good morning from San Francisco. We were just showing some of your portfolio companies, and I was interested in what you were saying about electrification and asset-light model. But one of those names is Zipline. And I'm always curious about Zipline. I always bump into Keller Ronaldo, the CEO at Sun Valley. Is Zipline an IPO candidate?
Zipline will be an IPO candidate given its size and its scale and its growth trajectory. You just saw that they announced a really big deal with Walmart to serve the Dallas area with their drones. We're beyond the pilot stage. We're beyond the trial stage. We're now at the stage where you can actually implement these kinds of deliveries, and you could do it on scale.
So we've been talking a lot on the program today about Reddit. We understand it's talking to the bankers and talking to its investors and saying, if we IPO, where should we do it from a valuation perspective? And it's looking like $5 billion is about right, down from the $10 billion where they last raised or were valued last time. But we're trying to understand if it's a starting gun for the 2024 IPO window. So give me the Eric Hippo thesis and outlook for that this year.
Yeah, well, there's nothing like the truth about them going public, their reported revenues are about $1 billion. So $5 billion valuation of 5x on that seems reasonable to me. Obviously, there's a lot we don't know. We don't know the growth rate. We don't know the bottom line that well. So it could be a little bit more than $5 billion if the growth rate is higher and if the company is profitable. But 5 at the moment, given what we know, seems like a reasonable valuation.
What's so interesting is we get this breaking news across the IPO sphere at the moment, Eric, and I'm looking at how Renault, a European company, they built a sort of spin-off, Ampere, which is they call it the only European EV and software pure play. Their intention was to IPO this unit. We now learn that they are not going to be seeking an initial public offering in the near term because of current equity market conditions. Basically, look, the valuation isn't going to be right and there's too much volatility. How much is that going to be the theme of 2024 more broadly? How much do you worry that this window isn't going to open?
Well, this has been the problem with the IPO market for a number of years now, with the exception of 2 years ago when we had the SPACs and all the SPACs and kind of the failure of the SPAC structure, and we're back to kind of like the doldrums when it comes to being able to go public, and that's really dangerous. It's obviously dangerous in my business because we expect an exit, whether it's M&A or an IPO. But I think it's dangerous on a broader sense. We now have less than half of the public companies that we had in the mid-'90s. In the mid-'90s, there was a little bit more than 8,000 public companies. I'm talking about the U.S. And today, there's less than 4,000. And that number keeps shrinking. So what does it mean to be in a world where we have fewer and fewer public companies and it's very hard to go public? I don't think that's favorable to the economy.
Eric, this is VC Spotlight, and the story of 2023 was a drop in activity, right? Volume or dollar perspective for venture-backed deals. But there seems to be some kind of like stabilization at the start of the year. AI had sucked all of the very little oxygen out of the room. Are you back to kind of writing checks across a broader range of sectors now?
We are, and we've been back, I would say, since kind of mid last year. And for us, it's not a question of lack of opportunities, because we see thousands of new companies every year, and we make, we typically make 15 to 20 new investments every year. It's in good part, it was because the valuations were still too high. And remember, we're seed investors first, so we are very early investors, and getting started with the right footing, on the right footing with the right valuation is critical to what we do. And what we're seeing now is that there's much more, realism in that world, and people are being more, reasonable as far as valuations are concerned. So we're back on track in terms of making our regular number of investments. Where the market is still kind of like shut is on the late stage. So if you take Series C's and beyond, it's very hard to get a company financed at that level. Whether this opens up again in 2024, it's too early to tell.
All right, Larry Hippo, managing partner, Eric Hippo. A lot of experience and a broad conversation. We really appreciate it. Thank you. Now, coming up here on the program, X is trying to stop the spread of fake images of Taylor Swift. We're going to take a closer look at deepfake technology, not just on that platform X, but across social media more broadly. That conversation next. This is Bloomberg Technology.
A little bit of breaking news when it comes to the shares owned by Delivery Hero of Deliveroo, which is a UK rival in food delivery. Delivery Hero will be selling up to 68 million Deliveroo Class A shares, we understand. So there's going to be some supply pressure on Deliveroo shares in the market after the market close, of course, that occurred about 20 minutes ago. So some European action when it comes to food delivery. Meanwhile, let's talk about social media at the moment and what's happening right here in the US and more broadly worldwide, because the site X is currently blocking some searches for Taylor Swift. That's after pornographic deepfake images of the singer, well, they've been circulating online. This is as consumer protection is front and center at social media giants, with ex-CEO Linda Yaccarino and the CEOs of a number of other technology companies actually scheduled to appear before the Senate on Wednesday to testify about protecting children online in particular. Joining us now from Washington is Bloomberg social media reporter Alex Barinka. And you've really already been incredibly busy with 2024 and deep fakes, whether it's a voice of Biden or whether it's fake pornography involving Taylor Swift, and there's just no regulation for it.
Certainly, January was the month of deepfake AI videos on social media on the heels of the Taylor Swift explicit images going viral on X last week. We really got to see kind of the slow nature of chasing and taking down some of these images and videos on social, now that these tools, these AI tools, are really cheap and easy to get their hands on. That Taylor Swift debacle on Wednesday was just days after robocalls of Biden went out to New Hampshire voters. They were obviously fake, and they were urging voters to hold their votes and not go to the polls, which is not how the election works here in the state. So we are starting to see kind of the real implications. Those of us in the tech industry, we've been seeing this happen across the internet, but this past month, it seems like the public is really getting to see some high-profile examples of what happens when AI hits social media with bad actors trying to put out either fake or damaging information.
Alex, let's look ahead to Wednesday. What is the aim of this committee hearing? What does DC want to get out of it?
Well, the CEOs of Meta, X, Discord, TikTok, and Snap will be at the Senate Judiciary Committee on a hearing focusing on child safety. Now, just before this hearing last week, Snap was the first tech company to actually come out in support of the Kids Online Safety Act, which would put in regulations to protect kids online. But this is not my first hearing, and I can tell you guys, I bet there will be questions that are outside of just kids safety as well. TikTok and its Chinese parent owner always is a hot button issue, so we might see some questions directed to the CEO of TikTok's way around China and data protection. And also, guys, after this deep fake debacle on X, I would expect ex-CEO Linda Yaccarino to get some very pointed questions, particularly around why some of these posts got 47 million views and took almost a day to take down.
Alex Barinka, we thank you so much for the latest on the reporting across all of that. Meanwhile, that does it for this edition of Bloomberg Technology, Ed.
Yeah, don't forget to recap on the podcast wherever you get your podcasts, Apple, Spotify, iHeart, and all the Bloomberg platforms. This is Bloomberg Technology.